Let's turn back to markets and that news briefly today that the NASDAQ was positive for the year. Lori Calvasina, RBC Capital Markets head of U.S. equity strategy, is joining us right now. And one of the things that you had said in your notes to us before the segment, Lori, is that your year-end prediction for the S&P 500, your target is 2,750. So not too optimistic, are you?
No, look, the way we characterize ourselves these days is pretty neutral. We don't really feel a compulsion to pull that target up. We don't really feel a compulsion to pull that target down. Generally, we think that equities have priced in a lot of good news for the equity market rally to keep going from here. Things have to play out pretty perfectly in terms of the virus, in terms of the economic recovery. But frankly, we think we're entering into a phase where we're going to start looking at derivative impacts of this crisis. We think that's going to really be the story later on in the year. We do think there's risk that we take a move lower from here. We think there's going to be a lack of earnings visibility for quite some time. And what we learned back in 08-09 is that until the sell side really gets a handle on where earnings are going, it's really hard for markets to stabilize.
Well, Lori, it's Julie here. Hi. So speaking of visibility, you're looking out even past 2020, looking to 2021, and there the consensus earnings estimate is still for a $2 increase in earnings per share over 2019. You think that might be too optimistic? I mean, given the lack of visibility, how do we even say that's too optimistic or too pessimistic at this point?
Yeah, so, I think when times are uncertain, we have to do the best we can with our models, and we also have to rely on logic. And I'll tell you that our model, which actually does bake in a pretty favorable economic scenario in which GDP starts to grow sequentially in 3Q versus 2Q and continues sort of a pace of slower growth into next year, we're only coming up with 153 on earnings. We were at 165 back in 2019. Our latest tracking on the bottom-up consensus has been that you're around 166. 167, so right back to where you were in 2019. Our math doesn't bear that out when we've put in what we think is a very reasonable scenario and frankly not a pessimistic one. And also logically, we just don't think it makes sense to say that we're going to be able to bounce out of this so quickly. We're going to go right back to pre-virus levels next in 2021. It just doesn't make a lot of sense to us intuitively.
Lori, I'm curious about your models and how you work in, if you work in, consumer sentiment as it may lead to consumer demand, because you pointed out to us that in the Northeast, it's worse than other parts of the country. The Northeast is such a large population center, and with demand destruction, it sounds like you're not expecting demand to come back quickly.
It's a great question. To be honest, we don't factor the regional imbalances into our model. In theory, it should show up somewhere in our GDP assumptions. But I'm glad you picked up on that chart. It's one that we've been highlighting the past few weeks, but frankly, we haven't been talking about a whole heck of a lot. One of the things that I have noticed in my conversations with investors and traders is that there's a lot more pessimism in people's voices if you talk to people in New York, if you talk to people in Philadelphia, if you talk to people in Boston, areas that either are in the heart of this coronavirus crisis or close to the areas that have been hit very hard. When you talk to people in the Midwest, the South, Texas, we tend to find that the outlooks are a little bit more optimistic, and we see that reflected in consumer confidence data.
Hey, Lori, it's Brian Chung here. So I'm just wondering on the equities front, it seemed like it was a little bizarre to see all the indices kind of rally here. I think the NASDAQ actually briefly went positive for the year to date. Where is the disconnect here as we see this record number of jobless claims come in, and with the number that we expect to see tomorrow morning, it seems like there's a huge divergence here.
Yeah, so what I would say is while I do have concerns going forward, and I am anticipating choppy markets going forward, I do think the rally that we have seen so far, it makes sense from a certain perspective. I view it as a legitimate rebound. I think it may turn out to be wrong. I think it may turn out to be premature. But I think it's predicated on a couple of things. One, we've had enormous Fed stimulus. And so if you go back and look at the post-financial crisis era, whenever the Fed released a torrent of stimulus on the market, stocks bottomed. That may have been what happened this time around, and we do hear a lot of confidence in the Fed when we talk to investors. Secondly, I think that investors are more focused on rate of change than level. Now, of course, that rate of change needs to continue to improve to keep buoying stocks, but historically, when you go back to past crises, things can bottom out when things still feel pretty icky, still feel pretty terrible, but things start to get a little bit less bad. I think the concern I hear from investors that makes me question whether or not that rate of change is going to continue to improve is the idea that we're going to get back to normal pretty quickly. And I think for that rate of change to kind of keep moving in an upward trajectory on a lot of these different data points, you're really going to have to see things do spring back and go back to where they were pretty quickly. And again, as we talked about earlier, I just think that's not quite right in terms of assumptions going forward. I think we'll have some lasting wounds and scars for the consumer in particular, especially those in the Northeast.
Hey, Lori, it's Julia LaRoche. I want to get your take on what else you're paying attention to. I read in your note that you were talking about the stocks held by the hedge funds were actually outperforming. So my question to you is, are they all in the same names here? And what are those names? And then why is it that there's more bearish sentiment from the retail investors?
Okay, so two great questions. Number one, I would say in terms of the names most heavily owned by hedge funds, a lot of these are TIMT, tech, internet, media, telecom focused. And a lot of them, if you just sort of think about what kinds of companies they are long-term secular growers. They're really the darlings of the hedge fund communities and active managers in general. And what we have seen is that they've had a pretty good earnings season so far. So they do seem to deserve that continued outperformance from an earnings perspective. But also, I think at a time where valuations are in question, really, what else can you invest in other than long-term fundamentals? And the companies are certainly managing to come through in the short term. So we're seeing, good reasons for these stocks to continue to outperform. I think there's a feedback loop here as well, because hedge fund performance has been, kind of helped by these names. I think that's instilled some degree of confidence in the hedge fund community. There's not a lot of panic going on there. I think that's been healthy and constructive for markets. In terms of the second question on retail investors, it's interesting. We've seen the data bob around on the AAII survey, which is something we track pretty closely. At its peak, that survey has only gotten up to about 52%, which is what it tends to see, where bearishness tends to peak out if you're not in the financial crisis. So that was the high around 9/11, for example. It's really been interesting to me why the retail investor has not reacted in a bigger way than they have. We don't think we've ever really seen capitulation on the retail investor side. I think it's just something we're going to have to watch going forward. So one of my clients posited a theory to me, and he said this drawdown happened so quickly, the retail investors just didn't have time to react. But now if we're confronted with job losses, with wage reductions, which we're starting to hear some companies talk about, you could see that start to change a little bit.
So Lori, it's Julie again. Put all this together for us and tell us what you're advising clients to do right now. If indeed sort of the TMT space has been performing a little bit better, if perhaps stocks have bottomed, is that the place to go right now? I know that you're watching healthcare as well as a possible outperformer.
Yeah, so I would say we're thinking about positioning in a couple different ways. Is number one, in terms of our sector overweights, we've really been emphasizing to investors we want to keep a balance. So we want some cyclicality. Our favorite cyclical rebound play right now is industrials. We think that people will go back to work before they'll go back out to having fun. In terms of sort of our long-term secular growth pick, we like healthcare. Now we're neutral on technology, so we're not saying to underweight that space. But healthcare we think is going to be one of the heroes of this crisis, and we think there are going to be some long-term tailwinds because of that. We also think valuations are very reasonable there. And then our defensive pick is actually utilities, which we think has better valuations than what you see in things like staples. REITs we think have some fundamental challenges, but we really want to keep that balance. Now I'll tell you, in terms of the growth value debate, one thing that investors have been talking about a lot is, okay, so what does well in the rebound? Does value do better? And we see that in small cap. We actually don't see that in large cap. But we've actually told investors, look beyond that initial knee-jerk reaction trade. Longer term, once we have that initial rebound in the economy, when we get a sustainable rebound, in my opinion, in the market, we're going to be back to a backdrop where economic growth is sluggish. We don't think we're going to be going back to a rip-roaring economy. We think that favors secular growers.
Okay, Lori Calvasina, RBC Capital Markets, head of U.S. Equity Strategy. Good to have you here. Stay healthy, stay safe.
All right, thanks, guys.